The rise and fall of GameStop. Ever wondered how GameStop went from a small video game retailer to making headlines worldwide? Beyond the stock market chaos lies a story of highs and lows waiting to be explored. The world of finance was turned upside down in early 2021 when a video game retailer, GameStop, became the center of attention for investors around the globe. What started as a struggling brick-and-mortar business transformed into a symbol of rebellion against Wall Street giants. But before we dive into the details, consider this. What fueled GameStop's meteoric rise, and what led to its sudden decline? The answer isn't just in the numbers, but in the people and events that shaped its destiny. Let's delve into the remarkable saga of GameStop's rise and fall, a story that captured the imagination of both seasoned investors and ordinary people alike. GameStop, originally known as Babbage's, started its journey in 1984 as a small retailer of video games and consoles. Founded by David Cook, it was a modest store at first, serving the niche market of gamers. Over the years, GameStop expanded through acquisitions, buying up other gaming retailers like Funkoland and EB Games. These acquisitions helped GameStop grow into a major player in the video game retail industry. Through strategic expansion and a focus on customer experience, GameStop established itself as a go-to destination for gamers looking to purchase the latest titles, consoles, and accessories. By the early 2000s, GameStop had become a household name for gamers across the United States, with a widespread presence in malls and shopping centers. GameStop's rise was not without its challenges. In the late 2000s and early 2010s, the gaming industry underwent a significant transformation with the rise of digital downloads. More and more gamers were choosing to purchase games digitally, directly from online platforms like Steam, PlayStation Store, and Xbox Live Marketplace. This shift posed a threat to GameStop's traditional business model, which relied heavily on the sale of physical copies of games and consoles. As digital downloads became increasingly popular, there was a decline in the demand for physical discs and cartridges. Gamers found the convenience of downloading games instantly to their devices appealing, eliminating the need to visit a physical store like GameStop. GameStop's revenue from new video game software sales, its most significant source of income, began to decline as a result of this shift. Investors and analysts grew concerned about the company's ability to adapt to the changing landscape of the gaming industry. Additionally, the emergence of online retailers like Amazon posed competition to GameStop's brick-and-mortar stores. These online platforms offered a wide selection of games, often at competitive prices, further challenging GameStop's market position. Despite these challenges, GameStop continued to diversify its offerings, expanding into areas such as mobile devices, collectibles, and gaming merchandise. However, the core business of selling physical video games faced increasing pressure from the growing trend of digital distribution. This set the stage for GameStop's struggle to maintain its relevance and profitability in the face of a rapidly evolving industry landscape. The unexpected twist in GameStop's story came with the onset of the COVID-19 pandemic in 2020. As governments imposed lockdowns and people around the world stayed home to curb the spread of the virus, the demand for video games surged. With more time on their hands and a need for entertainment, people turned to video games as a source of escapism and social interaction. This led to a significant increase in the sale of video games and gaming consoles. GameStop, as a retailer specializing in these products, experienced a sudden uptick in demand. The company's stock price, which had been relatively stagnant for some time, saw a temporary boost amid the pandemic boom. Investors speculated that GameStop might benefit from the increased demand for gaming products during lockdowns. The real turning point for GameStop came in early 2021 when a group of individual investors on a Reddit forum called Wall Street Bets took notice of the company's stock. These investors, often referred to as retail investors, noticed that GameStop's stock was heavily shorted by hedge funds. Short selling is a strategy where investors borrow shares of a stock and sell them with the hope of buying them back at a lower price, pocketing the difference. In the case of GameStop, several hedge funds had bet that the stock would fall in value due to its perceived struggles in the face of digital competition. One of the most prominent figures in this movement was Keith Gill, also known by his online alias, DFFV. Gill had been posting bullish analyses of GameStop on Reddit and YouTube, advocating for the stock's potential to rise. As more and more retail investors piled into GameStop shares, the stock price started to soar. What began as a coordinated effort on an internet forum quickly gained mainstream attention. GameStop's stock price went from trading at around $20 in January 2021 to reaching an all-time high of over $400 by the end of the month. This unprecedented surge in GameStop's stock price captivated the financial world and became a symbol of the power of individual investors banding together against institutional investors. The movement was dubbed GameStonk as a playful nod to both GameStop and the stock market frenzy taking place. It was a remarkable example of how social media and online communities could influence traditional financial markets. As GameStop's stock price continued to rise rapidly, the short squeeze intensified. Hedge funds that had bet against GameStop found themselves in a difficult position. They were forced to buy back shares at much higher prices to cover their short positions, driving the stock price even higher. Retail investors, emboldened by the soaring stock price and the sense of a David versus Goliath battle against Wall Street, continued to buy GameStop shares. The frenzy reached a fever pitch, with many investors holding onto their shares in hopes of even greater gains. The short squeeze had a cascading effect, as the rising stock price triggered more short sellers to cover their positions. This created a feedback loop that pushed GameStop's stock price to unprecedented levels. At its peak, GameStop became one of the most traded stocks in the market, with millions of shares changing hands every day. The GameStonk movement had achieved what many thought was impossible. A struggling brick-and-mortar retailer's stock defying all logic and soaring to dizzying heights. The narrative of small investors banding together to take on Wall Street giants struck a chord with many, leading to a groundswell of support for GameStop's stock. However, amidst the euphoria of the moment, questions began to arise about the sustainability of GameStop's stock price. Analysts and experts pointed to the company's fundamentals, noting that its valuation seemed disconnected from its actual financial performance. GameStop's business model still faced significant challenges, including the shift to digital gaming and competition from online retailers. Additionally, the unprecedented volatility in GameStop's stock price raised concerns among regulators. The Securities and Exchange Commission, SEC, announced that it was closely monitoring the situation, and trading platforms like Robinhood imposed restrictions on trading GameStop and other volatile stocks, citing risk management reasons. These actions led to backlash from retail investors, who accused the platforms of siding with hedge funds and limiting their ability to trade freely. The controversy further fueled the narrative of a battle between Wall Street institutions and individual investors. The fall as GameStop's stock price continued its wild ride. Regulators stepped in to address the unusual trading activity. The SEC announced investigations into potential market manipulation, focusing on both retail investors and hedge funds. There were concerns that some individuals might be coordinating to artificially inflate the stock price, a practice known as pump and dump. In response to the heightened scrutiny, trading platforms like Robinhood restricted trading in GameStop and other volatile stocks. This decision sparked outrage among retail investors, who saw it as favoritism toward institutional investors and an infringement on their ability to participate in the market freely. The restrictions on trading and the regulatory scrutiny contributed to increased volatility in GameStop's stock price. After reaching its peak in late January 2021, the stock began a sharp decline. Many retail investors who had bought at high prices found themselves facing significant losses as the stock price corrected. The roller coaster ride of GameStop's stock price reflected the chaotic nature of the market during this period. Prices swung wildly, with dramatic gains followed by steep losses. The volatility made it challenging for investors to predict the stock's movements, leading to uncertainty and anxiety among shareholders. The GameStop saga caught the attention of lawmakers in the United States, prompting a congressional hearing to investigate the events surrounding the stock's unprecedented rise. In February 2021, the House Financial Services Committee held a hearing where key figures, including executives from Robinhood, Melvin Capital, a hedge fund heavily involved in shorting GameStop, and retail investors, testified. The hearing shed light on various issues, including market transparency, the role of social media in influencing stock prices, and the impact of retail trading platforms' decisions on market dynamics. Lawmakers questioned whether existing regulations were sufficient to prevent market manipulation and protect investors. By mid-2021, GameStop's stock had returned to more realistic levels. The hype and frenzy that had surrounded the GameStop movement had subsided, and the stock was trading around $150 per share, significantly lower than its peak, but still well above its pre-frenzy levels. The GameStop saga left a lasting impact on the financial markets, sparking debates about market dynamics, investor behavior, and the democratization of investing. It highlighted the power of social media and online communities in influencing stock prices and challenging traditional Wall Street practices. While the saga of GameStop's rise and fall was extraordinary, it also served as a cautionary tale. It reminded investors of the risks associated with speculative trading, the importance of conducting thorough research, and the need for robust regulations to ensure market integrity. Conclusion: the rise and fall of GameStop was a wild ride that captured the world's attention. It showed the potential for retail investors to disrupt traditional finance and challenge the status quo. And there you have it, folks. The incredible tale of GameStop's rise to stardom and its turbulent descent back to reality. What a wild ride, right? But hey, who knows what the future holds for this gaming giant? Thanks for joining us on this journey. Don't forget to hit that like button, subscribe for more thrilling content, and keep gaming on. See you in the next video.